Welcome, everyone, to this edition of the Healthcare Labyrinth Podcast. My name is Marc Ryan, and it's a pleasure to be hosting this podcast. I truly appreciate every one of you listening in. As I always do, I'm going to start out a little bit with what the healthcarelabyrinth.com website is. So very quickly, we do a weekday daily news feed, so 5 times a week, and I summarize and sometimes comment on various news articles of the day. It's a quick way for you to become up to date on the issues of the day without perusing the 24 or so websites that I do. And that's available at the newsfeed tab on healthcarelabyrinth.com. Second, we have 2 blogs a week, again, covering major news stories, sometimes from the newsfeed, other news stories that are out there, and sometimes also at the request of readers or listeners. And we've written a couple of blogs already from requests from readers and listeners, so you can always comment on the website and ask me to cover a given topic as well. And so 2 blogs a week available on healthcarelabyrinth.com at the blog tab. And lastly, the podcast is once a week. You can listen in for a feature-length podcast either at healthcarelabyrinth.com by pressing podcast tab, or you can listen on leading applications and podcast websites out there. I would also note you can purchase my book, The Healthcare Labyrinth, at healthcarelabyrinth.com. It is available in hard copy, in ebook, as well as an audiobook from leading retailers in the nation. So with that, let's get to the topic of the podcast, which is major health insurers and their profiles and how they have some differing approaches depending on the company out there. This actually came in as a request from a reader who, noted that there's a lot going on in the health insurance world. There's a lot of talk of different strategies, and this reader wanted sort of a summation of some of the leading insurers, how big they are, what lines of business they're in, and what their overall strategies are. So I was actually quite impressed with the request. I think it's actually a very important thing to think about. Oftentimes we think the health insurance world or the world of health insurers is fairly monolithic, but it's really not. And so there are different strategies and different types of companies that have emerged out there over time. And so it was really fun for me to do some research on these health insurers and what it means. So what I did to keep it rather simple was I picked an area that generally had a lot of public information. And so what I did is I took the 7 largest insurers owned by for-profit, publicly traded companies. And the reason I did this is because, as I say, there is a lot of information out there on these companies because they are publicly traded and they have SEC and other requirements for disclosure. So it makes researching these companies pretty easily. So these 7 companies, sort of in enrollment order, just to go through them right now, are United Health Group, which owns United Healthcare. The second one is Elevance Health, formerly called Anthem, which has about 14 Blues plans around the nation, Blue Cross and Blue Shield plans. The third one is CVS Health, which owns the insurer Aetna. The fourth one is Centene Corporation, which is a combination of the old Centene and WellCare. The Cigna Group is next, which is Cigna Healthcare is the insurer. Next one is Humana, which is an insurer. And last is Molina Healthcare, which also is an insurer. So those are the 7 companies we'll be talking about in this podcast. Now, collectively, they cover about 200 million people, which based on a population estimate recently of 330 or so million people, that's about 60% of the U.S. population. So these 7 are fairly big in terms of covering a majority of the U.S. population for healthcare needs. Collectively, their revenues are over 1.25 trillion annually. So that's quite impressive as well for 7 companies out there. And again, what I did is I combed some investor relations filings and the health insurance investor relations sites for presentations and things of that nature. I also combed the internet generally for other information that I wanted to track down as well. And what I really did find is that some of these companies or insurers are very focused on insurance alone, no question about it. But many of them also are a bit focused on diversification from just insurance alone to strengthening what we think of as service units. So as we talk through this, I'll be talking about what is more of a pure play insurer, although that's not always the case. They do have other assets that tend to support the insurance entity versus other companies that are diversifying. They have a core insurance subsidiary, but they also have these service units that supply services to the insurance company they own, but also supply services to many, many other health insurance entities out there as well. So a few quick points. The insurers that I just listed in order was based on Q3 2023 membership, not 2022 revenue. There are differences in the ranking when you think of revenue versus membership, and that's for a number of different reasons, including the entities owning other types of assets beyond insurance. When I give these membership numbers, I am counting what I call core U.S. lives. So core to me, again, is U.S. lives, and it is medical policies in the commercial world, the federal employees world, the military or TRICARE world, Medicaid managed care, and Medicare Advantage, Medicare Part D, Medicare Supplement, those kind of policies. I don't count various specialty or ancillary policies like dental and vision and accident and sickness policies that might be sold by these companies. And again, I don't count international lives. In general, margins for these businesses, these 7 businesses, can range from about 4% to 6% on average over time. In given years, they may be less. As an example, when they write down certain issues, but generally speaking, it's a fairly in this 4 to 6% on average margin. Those that have more Medicaid lives and, say, retail businesses, in addition to their insurance, may have slightly lower returns over time, while those with heavy concentrations of commercial and Medicare Advantage tend to have higher margins. But again, that 4 to 6 numbers is a pretty good one to think about. Insurance units' medical loss ratios, or the amount of medical expense spent against the premium collected, can be in the low 80s for those with commercial and Medicare Advantage, maybe low to mid 80s. And they generally are in the high 80s for those insurers with a very high concentration of Medicaid lives, as an example. So another good barometer out there about medical expense. I also note that some of these insurers with Medicaid enrollments have recently suffered Medicaid enrollment losses, and they will continue to see those losses due to Medicaid redeterminations coming back. So in April of 23, regular Medicaid eligibility rules were reintroduced after the COVID pandemic flexibilities temporarily lifted regular rules, and no one could really be disenrolled from the Medicaid program. So each person will go through a redetermination of eligibility. Again, that began about April, and that process will last between 15 and 18 months, so it goes into 24. We are seeing huge Medicaid enrollment losses. Thus far, we've seen about 14.3 million have lost Medicaid coverage, and it will go up, as I said, because we're still in the middle of redeterminations. Most of those folks that lost eligibility were really on procedural grounds. They didn't return income statements, they didn't get their notice, things like that, and therefore were terminated. Some are gaining coverage back in Medicaid now that they're aware that they lost their coverage and they can file some paperwork. But in general, this process has a lot of problems. States are overloaded. We don't have good systems that talk to each other in terms of other programs to qualify people and things like that. So some people are gaining Medicaid coverage back. Others are going to employer coverage and exchange coverage and children's coverage, but many are falling through the cracks. So we'll see our uninsured rate increase probably in 2024, but also some of these membership numbers that I'm giving you have some of the Medicaid losses in them, but not all of them. So these membership numbers will likely change into 2024. So what I'm going to do now is we're going to jump into sort of our assessment of the 7 for-profit publicly traded insurers here. So I'm going to first talk about sort of what we think of as the granddaddy of insurance, which is United Health Group. And United Health Group in 2022, I use that number because we don't have final numbers for 2023 yet. But for 2022, revenue was about $324 billion. The Q3 2023 membership totaled a little over 50 million, about 50.5 million. And you'll see that United is pretty diversified. The commercial enrollment is about 27.3 million as of right now. Medicaid managed care enrollment is about 8 million. Medicare Advantage, they are the biggest player in Medicare Advantage, and they have 7.6 million members. They're very strong in Medicare Supplement as well, about 4.3 million. Medicare Supplement is sort of a secondary policy that would be taken out by seniors and the disabled that have traditional fee-for-service and are not enrolled in Medicare Advantage. And lastly, we know about the Medicare Part D program. That is, again, for fee-for-service enrollees largely, although some Medicare Advantage enrollees that don't have Part D coverage can also get a freestanding Medicare Part D plan, which is known as a PDP. And United has about 3.3 million members in PDP. So a total across a fairly diverse portfolio of enrollees across commercial, Medicare, and Medicaid lines of business is about 50.5 million. So let's take a look at a few of the highlights of United Health Group. So it is very diversified, within its insurance unit, but it's also diversified because it has both an insurance unit and a very, very strong services business. And I talked a little bit about what that means. Within services businesses, oftentimes can be a PBM. And so United is one of those companies that owns one of the big 3 pharmacy benefit managers, or PBMs. In this case, it's called Optum Rx. Its service unit is known as Optum, and that unit is clearly very strong and dominant. It's the largest services unit of any insurance entity out there. And it clearly is a huge focus of growth. It owns a lot of technology. It owns a lot of services business. It has Optum Rx, the PBM, as well. And it just tends to grow and grow and grow through acquisition and even organic growth. Again, Optum serves not only United Healthcare, the insurance unit, but it also serves many, many other insurers across the country with its vast portfolio of technology and services businesses. About 45 to 50% of the overall company's margin comes from Optum, which is pretty significant. And that seems to be growing over time as well. Optum also has been focused on acquiring physician groups, and it ties those physician groups very closely to its insurance entity. Many of those physician groups can be in the Medicare Advantage world, where there's a lot of risk funds that are set up, but they can also serve other lines of business as well through Optum. United, as I said, is the biggest Medicare Advantage player, and it tends to grow. It hardly ever makes a misstep. One of the reasons it is the largest out there is it has entered into a branding relationship with AARP, the retiree lobbying group and membership group, and it has those agreements on MA and on Medicare supplement and in other areas. So that will in and of itself means it's pretty well protected and will continue to grow along the way. United is, given its size and reach, forecasting slower MA growth just because it's so big and it's hard to continue to add at the levels it has in the past, but it will still be a powerhouse on the enrollment side overall. It has been very consistent in its star achievement, which is a big credit to United as well. On the Medicaid side, we do expect that it will be hit some and has been because of the Medicaid redeterminations and see some Medicaid managed care losses. So overall, United, very strong, diversified company. It actually came out with its Q4 results. The results were actually pretty good, but it did forecast higher medical expense in Q4, which spooked investors a little bit and sort of sent the stock price of United down. But nonetheless, there's no question that it's a very, very strong, successful, and growing company on the insurance side as well as on the Optum services unit side. So that's number one, the granddaddy, as we call it, United Health Group. Let's move on to Elevance Health. Now, Elevance in the past near term has rebranded itself from Anthem. Anthem and WellPoint a number of years ago was merged and created a broader Anthem. And again, the rebranding now is called Elevance Health. So 2022 revenue was about $156 billion. Its Q3 2023 membership was 47.6, about a little short of 48 million lives. And again, so it's sort of the second largest insurer out there now. Elevance is very, very strong in commercial. It has 31.7 million lives in the commercial world. It's very strong in Medicaid managed care as well. It's acquired various Blues over time and some other units that puts its Medicaid managed care membership up at about 11 million lives. It's a little bit smaller in Medicare Advantage. Medicare Advantage only has about 2.1 million lives for Elevance. It has pretty big federal employee coverage, 1.6 million. It has about 900,000 Medicare supplement lives, and it has about 300,000 Medicare Part D freestanding PDP lives. So again, a total of about 47.6 million. A couple of highlights on the Elevance side. I sort of think of Elevance as more of a pure play insurer, but it does have aspirations to grow its services unit. So while most of its activity today is sort of the insurer, it is building a service unit that will or is known as Carelon. So you'll start to see Carelon as a service unit be built out. It will include a PBM and, again, other service units along the way. So a little bit more on Elevance. It does not own a substantial PBM, but it's looking at building one. Again, it's been a very strong commercial player and Medicaid player, but recently it's been investing in Medicare Advantage as well by buying, smaller plans and in large concentration Medicare Advantage areas. It has struggled on the Medicare Advantage star front, so that's hurting itself a little bit in MA and revenue and things like that. And again, because it is such a large Medicaid player, it will be hit a bit by Medicaid redetermination enrollment losses moving into 2024. The third third largest membership entity we want to talk about now is CVS Health. And in 2022, CVS Health overall had about $322 billion in revenue. So it is actually close to the revenue of United Health. And what's interesting about CVS Health is it's really sort of a three-track type of entity. It has its insurance unit, Aetna. It has its pharmacy unit, which runs the pharmacies and related businesses. And then it has a bit of a service unit, its PBM and related businesses there. So we'll talk a little more about that in a minute. But let's talk about Aetna's and CVS's insurance membership. So again, about $322 billion in revenue in 2022. The Q3 2023 membership. Well, Aetna is very big in the commercial world. It has about 18.3 million lives. It's growing and has a fairly substantial Medicare Advantage business at 3.4 million. Recently, it was announced that Aetna will see huge increases in enrollment in 2024 in Medicare Advantage. So we look forward to that formal announcement. When we see enrollment statistics from CMS. Medicaid managed care, it has about 2.6 million lives, so it's been investing and growing there as well. It has a pretty strong Medicare supplement business with 1.4 million lives. And on the Medicare Part D freestanding PDP side, CVS Caremark, the PBM, always had a very large standalone PDP business, and that stands today at about 6.1 million. So the total lives for CVS Health in the insurance world is about 31.8 million, just short of 32 million. So again, I noted that there were three areas of revenue concentration: Aetna, its PBM and related businesses, and its pharmacies and related businesses. It does own one of the big three PBMs. I told you United owns Optum Rx. Well, CVS owns Caremark, and that is a very large PBM. Its PBM and related revenue is the biggest for all of CVS Health, with the pharmacy and related next, and then Aetna. Income, though, is roughly spread across the three types of revenue concentrations and investments. CVS is doing a lot to focus on building out primary care and similar investments, which will sort of be in the CVS pharmacies and tie very closely to the Aetna insurance business. Aetna had a huge turnaround to their credit on star scores. They were very low in 2023. They made huge investments. They came back in 2024. Which was fairly tremendous for them. And again, it says it will see big, huge increases in MA enrollment in 2024 because of that. Again, because it does have some Medicaid managed care lives at about 2.6 million, it will see some hit because of Medicaid redetermination losses. One thing I would know is, although CVS, again, is doing very well overall, it did lose Centene, another insurer we'll talk about in just a second, to Cigna's PBM. So Caremark, CVS Caremark PBM lost big insurer Centene, and Centene migrated over to Cigna's PBM on 1/1/24. So that was a bit of a hit. The relationship between CVS Caremark and Blue Shield of California also is being reduced in size, as Blue Shield of California looks to bring on a multitude of vendors to work on its pharmacy and only have CVS keep sort of the specialty business. So that will occur over time as well. But a couple hits, but overall, CVS is still doing reasonably well. So let's go on to our fourth corporation here. The fourth largest in terms of enrollment is Centene Corporation. And Centene's revenue in 2022 was $145 billion. Q3 membership was about just short of 28 million, 27.9. Now, what's interesting about Centene is by and large, it is centered on government programs. And again, Centene is a combination of Centene and WellCare. Centene was a very dominant Medicaid managed care plan. It bought WellCare. WellCare had millions of Medicaid lives, but it also had some very good Medicare PDP and MA lives. So the combination of Centene and WellCare under Centene has made it much more diversified within government programs. So Medicaid managed care lives are about 15.2 million. Medicare Part D PDP are about 4.5 million lives. Exchange lives, Centene has been it's the largest and mainstay in the Affordable Care Act exchanges. And I applaud Centene for always being there and never giving up, even in tough times. But exchange lives there are about 3.7 million. Medicare Advantage lives are about 1.3 million. TRICARE lives are about 2.8 million. Commercial lives are very small, about 400,000. And that again gives enrollment just below 28 million. I view Centene as more of a pure play insurers, again, with a focus on government programs, Medicare Advantage, Part D, Medicaid managed care, and the exchanges. Again, it was formed by the merger of Centene and WellCare. It does not own a PBM. Again, it recently moved from CVS Caremark on 1/1 to Cigna's PBM. We'll talk a little more about that in a minute. And it doesn't really have a very large services business, so that's why we call it more of a pure play insurer. It will be hit by Medicaid redeterminations, obviously, given the 15 plus million lives in Medicaid. And as one of the biggest exchange players, if not the biggest one out there, it will gain there as well as people move from Medicaid when they're disenrolled over to the exchange. One of the negative sides of Centene right now, it is battling very low star scores in Medicare Advantage. So that is really hitting its competitiveness, and they really have to find a way to turn the star situation in Centene plans around. It does appear that Centene lost some enrollment during this Medicare Advantage open enrollment season. Some of that was planned because they were pulling back in certain markets to obtain better profitability in Medicare Advantage, but some of it was probably also related to the hyper competition within MA right now. Let's go to the fifth ranked membership plan now. We've gone through United, Elevance Health, CVS Health, and Centene. We're now going to go down to Cigna. And the Cigna group, for 2022 revenue, it was about $181 billion. Q3 23 membership was about a little over 20 million, 20.5 million. It's a dominant commercial player with 16 million lives. Its Medicare Part D PDP, freestanding PDP, has 2.5 million lives. It has been a mainstay in the exchange as well, and it has about 900,000 lives. So I applaud Cigna for always being there along with Centene. Both of them created important stability in the program in very lean years. Medicare Advantage is pretty small. It's got about 600,000 lives, and Medicare Supplement has about 500,000 lives as well. So a couple of points on Cigna. Cigna is strong in the commercial arm. less so in other areas. It actually recently sold off its Medicaid line of business. And again, its Medicare Advantage lives are pretty small right now. Its PDP lives are bigger because of its PBM. But it is rumored to want to sell off its Medicare Advantage lives as well. We don't know if that will happen, but that's what's out there. And therefore, the CEO, David Cordani, would really focus on two areas. One, further building out commercial. And number two, he has been working to really grow the services business, which has recently been renamed and branded as Evernorth. Evernorth owns one of the big three PBMs, Express Scripts, and ESI, that's Express Scripts, had that huge victory in attracting Centene as of 1/1/24 as part of the PBM client base. And there are a number of other service units that not only serve Cigna, but other insurers. So Cordani would like to stick with core commercial and really build out that service unit called Evernorth and have it a bit compete with Optum up under United as a service unit. What's interesting is about 55% to 60% of Cigna's group's margin comes from Evernorth already. So it's a rather strong driver, not only of revenue, but also of margin. So it's looking to grow that entity a lot more. And again, deprioritizing Medicaid and Medicare Advantage. It has struggled on Medicare Advantage to really attract enrollment. It has misfired during the open enrollment cycles, and it has star challenges as well. So part of the reason it might get out of the MA business. That really is a wrap on the Cigna Group. It should, though, gain some exchange lives due to the Medicaid disenrollments. It doesn't have Medicaid managed care anymore, but it probably will gain exchange enrollment given Medicaid redeterminations. So let's get to our sixth largest insurer, and that's Humana. And Humana had 2022 revenue of $93 billion. Its Q3 2023 membership was about 17 million. It had about, its biggest area is clearly Medicare at 5.9 million, along with TRICARE Military at 5.9 million as well. Medicare Part D PDP 2.9 million, Medicaid managed care 1.3 million, commercial 700,000, and Medicare supplement at 0.3 million. But you will see a trend here. Humana is a bit of a pure play insurer with a focus on government programs, Medicaid, Medicare, and military. So it's really carving its niche out there. It is the second largest Medicare provider out there behind United, and that's where it makes the bulk of its money. It has grown well in MA and sustained very good star scores similar to United. Bruce Broussard, although there was one misstep there a few years ago, has absolutely run and built an incredible MA business, and Bruce will be retiring sometime at the end of 2024. But he really has built a tremendous Medicare Advantage and overall Medicare business. It is growing its Medicaid line as well, which is interesting. It really wants to go a little more in there, and it's won some critical business and states and will grow that out, but it's still pretty small at 1.3 million. It could see some lower membership again because of Medicaid redeterminations. It has announced it will shed its commercial line of business because it really isn't strong there and doesn't really want to focus. It's a bit of a distraction. So those 700,000 commercial lives will go away. While it does not concentrate on a service unit per se, it has bought major senior-related assets, including physicians and senior-related providers. So it sort of has an internal services unit, but that unit is very, very much focused on strengthening the core insurance business. It also does not have a major PBM, but may try to grow something like that in the future. Humana reported two concerning things at its recent Q4 2023 investor conference call. Number one, it said that its medical expense or MLR ratio went over 90% in Q4 2023 for Medicare Advantage. So that sent Humana stock and the stock of some other insurers down. We will expect to see other similar reports of increases in medical expenses from other insurers, just like we have for Humana, and I mentioned for United earlier. Number two, Humana was projecting slightly lower enrollment growth in MA during the 2024 open enrollment season, just because of its sheer size. But it reported enrollment growth has come in even less than predicted. And so that was a slight misstep on MA enrollment growth for 2024 so far. And we're going to go to the seventh and last of the largest publicly traded for-profit insurance organizations, and we're going to go to Molina Healthcare. And Molina had 2022 revenue of $31 billion. Its Q3 23 membership was about 5.4 million, and it is largely focused on Medicaid managed care in states. So it has about 4.8 million Medicaid managed care lives. It is starting to grow its Medicare Advantage business, largely in the dual eligible area because of its Medicaid concentration. It has about 300,000 Medicare Advantage lives. It also has about 300,000 exchange lives, so a total of about 5.4 million lives. Molina suffered some major financial difficulties some years ago, and it really continues to recover from that. It is bouncing back. It is largely a pure play insurer. It does not have a major services entity or a PBM. It is focused again on Medicaid managed care, and it will be building out its MA business. It will see some lower membership due to Medicaid redeterminations, but generally speaking, it's coming out of its financial slump. It's concentrated as a pure play government programs entity by and large. So that's pretty much the seven big players. And just to summarize a bit, what did we learn? Well, we do see a couple of these insurance-related entities focusing on diversification. So let's talk about those very quickly. United Health Group, already very diversified between insurance with United Healthcare and its Optum service business. Next, we see CVS Health as tremendously diversified between the Aetna insurance entity, PBM, and service units there, as well as its pharmacies. The world of Cigna is looking to build a very big Evernorth service unit along with its investment in the commercial line of business. And then we have what we think is the more pure play. Elevance, a bit of a more pure play, although it has aspirations to build a service unit with Carelon. Centene, pure play insurer with government program focus. Humana, pure play insurer with the government program focus. And Molina, a pure play insurer with a government program focus. So that is basically the status of these seven large publicly traded insurers. We hope you enjoyed listening in about the diversification or not, depending on the insurer. And we'll conclude this edition of the Healthcare Labyrinth. I hope this information will really serve as a foundation in the future for some of our continuing discussions. With that, we'll see you next time on the next Healthcare Labyrinth podcast.